Right now, the monthly chart of silver, as we talked about, is the tide is going down. It's in a long-term downtrend. It's at resistance. If it starts to roll over, it can move a lot lower, back down to the 18 level or beyond.
Over the past year, there's been an unprecedented demand for gold, silver, and other precious metals. This surge in demand, coupled with changing geopolitical dynamics and the uncertain state of the U.S. economy, has caught the attention of analysts and experienced investors in the precious metals market. They are now predicting a significant price breakout for these valuable metals in the near future. Analysts and investors believe that the prices of gold and silver could experience a sudden surge at any moment as more individuals become aware of the rapidly evolving investment landscape. However, one expert has taken a unique perspective on the precious metals market. Christopher Vermeulen, a technical analyst, trader, author, and founder of technicaltraders.com, a platform dedicated to helping individual investors, financial advisors, and wealth managers protect and manage their investments, foresees another bull market for gold and silver on the horizon. Despite this optimistic outlook, Chris is not as bullish as other experts in the field. He points out that both gold and silver recently hit their lowest prices since June 8th. Chris warns that we may witness further downward trends in silver, which is known for its high volatility and has been subject to substantial drops of 6 to 8% within a short time frame. In contrast to the more typical 1 to 2% drop seen in gold, Chris does not rule out the possibility of another 20 to 25% drop in silver in the short term due to its extreme volatility. However, he still considers gold to be the world's top safe haven asset. While Chris acknowledges that shifting geopolitical circumstances may provide some short-term support for these precious metals, he believes that a significant breakout may be elusive for a few more months. Nonetheless, Chris's bearish sentiments toward gold and silver are only temporary. Like other experts and traders, he anticipates a higher upward movement for both metals in the medium term. He expects this upward trend to materialize within the next 6 months to a year. According to Chris, this surge will mark the beginning of a precious metals bull market that could last for at least 5 years. In a recent interview with Liberty and Finance, Chris shares his insights and predictions for both silver and gold. But before we jump into the interview footage, we kindly ask you to take a moment to like this video, subscribe to our channel, and enable post notifications. Additionally, we encourage you to share your thoughts and observations in the comments section below, as your engagement helps us reach a wider audience. Thank you for your support, and we hope you enjoy the video.
Let's take a look at the silver chart. So silver and gold, I think, are going to more or less move together. So they have a very similar type of kind of trajectory. When we take a look at this chart here, this is the monthly chart of silver. And we can see we had a very big pop and rally after the COVID crash, and it's kind of been flagging sideways ever since. When we look at silver and we zoom in on this monthly chart, there is a very kind of significant trend at play here, which is a series of lower highs and a series of lower lows. And that's the definition of a downtrend. And right now it is trading right up in this previous high. It's definitely at resistance, and it's kind of been rejected. It's starting to move lower. So it's not the most bullish sign for silver in near term. I still think we're going to see silver potentially sell off quite a bit, move back down. I think there's still another 6-8 months probably before we see the precious metal space potentially become a rocket ship type of play where they go up and to the right for, I think, 3, 5, 7 years, a big leg higher. So that's kind of the take on silver. Gold is very similar, except for it's trading up near all-time highs. If we zoom way back here, silver is equivalent to trading down 50% from the highs, where gold is just threatening to break out. That's because gold is the global safe haven. It's a slower moving asset, so investors can put more money into it. A big day on gold is like 1.5%. Big day in silver is like 8 or 10%. So you got to be obviously more cautious with silver. But when we look at the monthly chart here of gold, when you and I were talking, gold was in pushing up here, threatening to break out. But all the market internals around the precious metal space at that time, I was telling you, are very bearish. We've got this major resistance level on the chart, which has been rejected twice in the past. Now we've got the similar type of reversal candles, which is a long upper wick, meaning price rallied up and then sellers stepped in and unloaded shares and drove the market back down. So that is a very clear sign that there's resistance up there. The other thing is silver is lagging and gold miners are, to me, kind of the more important aspect. If gold miners aren't participating, then gold probably isn't, starting the major big breakout just yet. And gold miners are down. They're down about 45% from the highs, very much so like silver. So typically you see the leverage play around a commodity move first, and that would be the gold miners. Silver doesn't have to move first. It can actually be a little delayed, but the miners are usually kind of the telltale sign that gold is going to break out or not, and they're just not participating. And just a really quick view so you can viewers here can see where the gold miners are. If we go back to 2011, 2012, here's the top, and gold miners are just like silver. They've got this kind of rally, but a series of lower highs and lower lows. They're just not participating yet. But gold miners and silver are creating this big rounding formation. It's a major base that means a huge rally down the road, but we're just not there quite yet.
Now, if we turn back to silver here, I know I'm no technical analyst, just to put that out there, but I know that in the short term, we are seeing some higher highs and higher lows kind of on a more short-term basis. If we go back from the low we saw, around $18, your perspective on that, is that significant at all, or are you more concerned about the longer-term trend? It does seem like, lower highs and lower lows there if you look longer term.
Yeah, so if we look, it all breaks down to the time frame of trader or investor you are. So you could argue here we do have a series of higher lows, we have a series of higher highs. So in the shorter term time frame, it is oscillating and trending higher, and it has been down near a support level. It's starting to bounce. So short-term traders, you look at this little trend, it's in a very short-term trend to the upside. This longer-term view that lasts, about a year almost, this is also kind of trending higher as well. But the long-term charts, those patterns typically trump all the shorter plays. So you got to be aware that, if we were to look at the silver chart, it's actually got a move down, and this little trend up is known as a bear flag pattern, which is the halfway point for a move. So we can use Fibonacci extensions, which is one of my favorite tools, is the most accurate technical tool that I know. I've used it for decades. It tells us where price is headed next, and it's based on the sell-off and the bounce. That is telling us how much downside potential there is. So right now, silver has got the potential to drop to $21, which is about a 12% decline. And that's kind of where that short-term chart is pointing to. So, you can break a chart down. If they're fractal, you can break it down to any time frame, and you'll keep flipping between an uptrend or a downtrend as you move time frames. The key is to understand what the longer term time frame is, like the tide of like the ocean. If silver tide is naturally going up, then you want to be looking at buying dips on the shorter term trends. But right now, the monthly chart of silver, as we talked about, is the tide is going down. It's in a long-term downtrend. It's at resistance, and I'd be very aware that if you're going long here, it better be for a quick play, and you better be very aggressive to protect your profits, because if it starts to roll over, it can move a lot lower, back down to the 18 level or beyond.
And can you go over for our viewers kind of your worst case scenario for silver in the short term? Because I know silver can move very fast, very quickly.
Yeah, so I mean, based on this initial little chart pattern here, $21 is that downside potential. If it bounces at that level and it forms another bear flag, it would probably be a larger bear flag. Then we're probably going right back down to 18. So it'll definitely do quite a bit of damage to the price action. Pretty much $24 right now, 18. That'll be a pretty major bottom. A lot of support will be down there. So yeah, there's a lot of downside potential. If it falls down there, investors need to know that's a 25% haircut, which is not easy to stomach. And I mean, I've talked to a lot of different financial advisors, and when any asset drops more than 8%, investors start to get really uncomfortable and panic. And, it's not something you really want you want to hold on to if it's going down. You can always buy it later, hopefully at a lower price, or you can always buy it later when it's in a new uptrend and it's going to go higher for years. Instead of, if you look at this chart, it's pretty noisy. It's all over the place. That is a roller coaster ride for somebody who, who just wants to kind of buy and hold it and ride that out. There's other assets to be, and we're along the NASDAQ right now. One of our positions there, we're up, we just hit a 30% target at the opening bell today. With that play. So instead of sitting here with your money in, potentially precious metals at the moment, you could be putting it into other sectors or assets that are rising. And when there's a financial reset and the precious metals space starts another major bull market, puts in a bottom, which you and I will be covering when that time comes, it's going to be the time to like buy physical metals and load up, because I think that'll be the time we go into a 5+ year rally in metals, and we've been waiting for it for a long time, and we're close. I feel like we're months, half a year, maybe a year away at the most, I think, but we're getting there.
No, it sounds like, and I know we covered this last time, that this pullback and then rally again, it sounds like the time frame is pretty short. This could all transpire in a half a year, a few months. So it's going to be a roller coaster ahead, it sounds like.
It is. It's going to be a big roller coaster. And the problem is, if the stock market eventually rolls over and sells off, like right now, the stock market is the indexes are in rally mode. You look at the NASDAQ, it's heading up. It looks like it wants to try and make a major double top. The SP 500 is in rally mode. But, for example, last Friday, I was watching the markets. They all closed positive, but almost every sector was red, closed down on the day, but technology and the AI movement and semiconductor space with Tesla and Apple, part of that rally. Everybody thinks the markets are doing really well, but almost most stocks are going down, yet the indexes are going up. And that's just, it's a house built of cards. And when that wave, this kind of tech bubble, kind of growth stock wave ends here, things are going to get ugly. We're going to see a massive sell-off, I think, in all asset classes, including precious metals. It's going to create that financial reset, and miners and metals are going to be probably one of the first sectors to bottom, just like they have in the past when we've gone through financial resets after the tech bubble, after the financial crisis 2008. So their time is coming for sure, and it is going to be a roller coaster.
The U.S. Federal Reserve has declared a pause on Wednesday after 10 straight rate rises that have lifted its benchmark rate to its highest level in 16 years. This news will surely relieve the market's strain. However, Fed officials feel that this halt will not be the end of rate rises. Given inflation remains over the central bank's 2% objective, they are framing it as a skip rather than a stop, with the primary purpose of giving the economy more time to absorb the impacts of the vigorous rate rise campaign. The Fed began raising interest rates more than a year ago, and research shows that higher interest rates take at least a year to have a broad influence on the real economy. As a result, the Fed will be able to assess the consequences of its rapid rate rises on factors such as employment and consumer expenditure. It may also assist them in avoiding a recession or mitigating the effects of one if one occurs. What is your opinion on whether the Fed has already harmed the economy? How do you think the market will respond to this pause following a string of rate hikes? Please provide your thoughts and insights in the comments below. Remember to like this video, subscribe to our channel, and turn on post alerts for more informative videos. Thank you for your time.